And welcome to another Lumi Financial Corner. With us once again, Michael Zaremsky, head of U.S. Private Banking, Bank Lumi USA, member of the Investment Committee for Lumi Investment Services. Michael, good to have you back.
Great to be back, Zev. Thank you very much.
So I got to give you kudos because since the beginning of the year, Michael, the one word that I've heard coming from you has been volatility. And now everybody's talking about it. So you were the first, or among the first, to really understand what's going on and predict it. And now it's the buzzword that everybody is throwing around.
Definitely, Zev. I appreciate the call out on that. And it's something that we've been very focused on within our investment committee within the bank is just, how the markets are going to be reacting to this normalization of policy and the new paradigm going forward. And we've definitely kind of hit the nail on the head with talking about increased volatility going forward.
So what does that mean for the average person when they hear volatility? Can we be a little more specific?
Zev, I'd be happy to elaborate on that point, but just let me remind everybody that the views expressed on this call are my views, not necessarily those of the bank or the broker-dealer. I think one of the real challenges that we do have in the world today is that everyone's always looking for black or white, and we're living in a world of gray. So there's no real absolutes, and everybody is looking for absolutes and for certainty. So I think one of the first things that we've talked about quite a bit is this normalization of monetary policy. And as I've expressed before, we went through a long period of time where everybody had great certainty and great conviction that the first rate hike wouldn't be until early of 2023. And even if somebody disagreed with that view, it was a minor disagreement, but most of the market was on the same page, and most people had a very, very similar view. When we look at the world today, and again, looking at some data from a couple of days ago, expectations for rate hikes for the balance of this year. So again, looking out over the next 10 months or so, the range of expectations goes from 2 on the low end of analysts surveyed on Bloomberg to 8 rate hikes. With a central figure around 5 or so, which is only about 30% of the people. So no matter how you slice it, whatever direction policy moves in, whatever the pace and scale of changes, the majority of the people are going to be wrong. There's not a majority view of what the rate hikes will be. It's just a plurality of around 5. And right now the market is pricing in somewhere around 5 to possibly 6 hikes. So again, where we're looking for this absolute of what is the answer, I think a lot of people are hoping that March 16th, which is a month away, we'll get some clarity. My guess is we'll get a little bit of clarity, but so much of the forward-looking view is going to be driven by data. That data is going through a lot of noise as we're still rehashing through a lot of best and worst data that got presented over the last year or two through the COVID recovery cycle. And again, I think that there's just going to be a lot of fits and starts as we move about this, as we determine what the actual pace of recovery is. Just to give a couple more examples of that, in the last 3 weeks or so, we've seen the 2-year rate rise from just over 1 to just over 155. So in the last 3 weeks, the market has basically anticipated another 2 rate hikes, which again, when you think back at the stability that we've had in the market prior, that's just a huge change. But you look at a lot of the data, and the data remains very healthy and very strong. The only reason why the Fed will be hiking is if the economy remains red hot. So the worst case scenario that gets bantered around is that somehow the Fed is going to make a policy mistake and rate hike our way into a recession. And again, if for any of those that listen to the Fed Governor Bullard, very clear that we need to look at the data. He's a bit more hawkish and believes we should be moving faster. Others on the committee may be a little bit more dovish, but I think that they're all uniform in the belief that we really need to look at the data and see how it happens. And he was pretty clear that there was no need to, hike ourselves into a recession. So again, looking at data. So in a world where we want to look for that black or white answer, yes or no, there's always a lot of gray. There's always a lot of maybe. And I think that that's some of the challenges that we're facing. And that also leads me to the next kind of issue with that is also the determination of why are you investing in the market? And I guess more importantly, are you an investor or are you a trader? If you're a trader in the market, then I think that you have you should be a lot more concerned about some of the short-term volatility that happens on a day-to-day or week-to-week basis. Most of our client base, and I think for most people that are in the markets, while they focus on some of the short-term news, ultimately they are long-term investors. And if you're a long-term investor, a lot of this short-term volatility is just noise. And while, again, it's much more pleasant to look at your balances when the market's up than it is down, the reality is I feel pretty certain that if you look out over a longer period of time, we can make an assessment that we'll probably continue to see equity markets, growing at an average annual rate of somewhere around 7 to 8% a year. And what happens this year, this month, this week, I have no idea, and I have a lot less certainty. But again, when we look through a lot of the short-term volatility, if you're a long-term investor, these could be good opportunities to buy. These could be good opportunities to reassess where you're at. Or in a lot of cases, it could be a good opportunity to sit there and say, I'm not really a long-term investor anymore. I need to think differently about it. And maybe I need to go to cash, or I need to move in a different direction. But again, from a long-term perspective, I don't think it really changes anything. And I go back to, again, one of my favorite Warren Buffett quotes, be fearful when others are greedy and be greedy when others are fearful. And if you're a long-term investor right now, there's a lot of fear in the market, and this could be a good opportunity for long-term investors to stay engaged.
Like you always say, Mike, you got to look at the bigger picture. You can't just look at short-term.
Exactly. But again, just to be clear, if you're somebody that's thinking about, buying something in the near term, a house, real estate, or some other type of investment, whereas over the last couple of years, it was easy to just sit in the equity markets or sit in fixed income or sit in some type of financial asset and ride it out for 3 to 6 months. Again, in a world of high volatility, if you are going to need cash for something, again, I think you need to shorten that duration. I think you need to come into cash, and there's nothing wrong with holding the cash that it's going to be there rather than risking volatility. So again, I think a lot of that determination is what is your time frame, what is your expectation, and how much risk can you take?
Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, member of the Investment Committee for Leumi Investment Services. Thank you for being here with us.
Thank you very much, Sev, and look forward to speaking again.
Look forward to that, and we're going to be right back.